PowerPoint right here. All right. I hope you guys could see my my slides. Cody, can you see it?
Yep, I see him.
All right, great. So thank you so much, everybody who joined us today. There will be two speakers today, me and Cody to share with Caliber Home Loans. As always, not sure why, but it's a little nervous, but we'll get the rhythm going and we'll get this baby going. So at first, few words about me. My name is Igor Pechkovsky. I work with Windermere Bellevue Commons. This is where my license is. I'm a residential retail broker. I've been practicing real estate for the past 3 years, and I've never really thought that I would be selling or helping residential clients to buy real estate. When I was going for my license, it never been an intent. I read years ago, Rich Dad, Poor Dad by Robert Kiyosaki, and I got really excited about investment side of the business of what opportunities it can bring. And if you guys could mute yourself, that'd be great, so we don't have get distracted on that. Yeah, right before I was getting my real estate license to be an investment real estate broker, I wanted to be learning more about real estate. I got laid off at work, and I thought, well, that was temporarily layoff. If I could, you know, if in the next 3 months, I had only 3 months, if I could potentially sell a residential home, I'll just go in and keep on working, and that would happen. And here we are 3 years later doing this webinar. A lot of things been learned, a lot of relationships being built. And right now, the business for me looks, I work kind of probably half and half. Half of my clients are investors. We seek for multifamily apartment complexes, for land for builders, fix and flip for our investors, and half we work with residential retail clients. So to me, I'm very passionate about real estate. I love to learn about real estate. I attend conferences, Zoom calls for the past 2 weeks. I spend a lot of time just learning, talking to people, to property managers, to builders, to contractors. What do you see? What's going on? Tell me how it is. I attended 2 real estate conferences, ton of Zoom calls, ton of webinars. I probably listened to 5 different chief economists of different companies to know what's going on. So today we'll try to break it down and make it really, really simple. I like simplicity, and at the same time, who knows me very well, they know that I never try to steer you one direction or another one. My goal today is just to provide some food for thought, and then you see what works for you. So that's a few words about me. All right, so topics we'll discuss today, we have where the real estate market is today. I have people are asking, so do people still buying, like, are people still selling? What's going on? What's the latest updates on our local economy? And I know for a fact that Cody will talk, there have been some changes on financing in real estate, and we'll try to figure out what's going on with financing too. And I would want to start with, if I do this correctly and I go back, there should be a pool. Before we start, I've got a pool which sounds like this. And this is really quick, just so we know where people are. What do you think will happen? There are always 2 sides to a coin, right? As Robert Kiyosaki says, there are always 2 sides. One is one side, another side, and the edge. I always try to look at and be on the edge of where this uncertainty will go, where the market will go. So my question to you is, what do you think will happen? And I really put 2 options. I haven't put too much thought in this. Option number 1, it all will crash. And option number 2, we will survive. So I'm gonna launch this poll. Take your time, just click on whatever you think will happen. And I'm talking about things in general, and I'll just share results with you. And we'll keep it till the end so we can come back and see how it goes. So let me see, we'll give it, we have 7 out of 15 people voted. Let's just spend another 30 seconds on this and we'll end. If anyone else wants to vote, it will crash or we will survive. 8 out of 15s. I'm gonna do 10 more seconds and we'll close this one. Just click one. I know it's kind of silly, but whatever it is. All right, so we've got 9, 10. I'll end this one and we have share results. So we have right now 2 people thinking that it all will crash. 15% to 15% think it will crash. And we have 11 folks, 85% think that we will survive. Okay. It's a good one. Let's keep going. Just wanted to check and we'll come back to that. So the question is, what a lot of people were asking me, what the heck is going on? And the problem is that we'll go with bad news first. Over the past 2-3 weeks, I haven't seen 0 positive articles about US economy. Seriously, 0. I usually read my main thing is I look at The Economist, which gives you kind of a broad perspective on the world, and I look locally in the Seattle Business Journal. There was nothing that looked optimistic at all. There was only one article that said that Boeing is going to reopen their factories, and 2 days later they sent another one. Oh nope, they're not gonna reopen anything. So massive layoffs. You always just read one company that is already asking for money, bailouts. You already see companies or some startups that closing their doors. So there was really nothing positive lately, which is not very good. Another one is unemployment is rising. It's not a secret. Any channel in the TV you look at, it talks about unemployment is rising, which is really, really bad. The first thing that somehow indicator of our economy is the stock market, right? Stock market was down. For me, stock market is more like a casino. It's gambling. I don't gamble. I know that has been a huge tool to make a lot of money previously, but at the same time, it went down really, really quick. So that's what we've seen in the news. But the worst out of all of those is there is uncertainty. The thing is that no one knows how much time it will take and which way it will go. That's the worst out of all, because we know that even if the country will get reopened, it will take time to somehow go back to normal if we can. And probably the most realistic way to look at it, whenever we get a vaccine, and I did a lot of reading just like all of us, but just kind of most likely when we will get a vaccine a year from today, life could go somehow back to normal. And that's the worst thing, because we just don't know how much time it will take and what will happen. And that's what drives this economy crazy. So if you look at different markets besides Seattle, those markets will take huge losses. And the first 3 that I kind of look at as just as an example, I think about Miami, Florida, and I think of travel. I think of cruises, I think of parties, of nightlife. Usually it's a very tourism-oriented place. It will take, massive losses. Cruises industries and so on, travel industry. There is not much otherwise going on in Florida. So same as Nevada, Las Vegas, you think of casino, right? So if casino is closed and all of the service people that service those casinos and everything around it, they don't have a job, like that area will take huge hit. Same Houston, Texas. If you think about energy in our country, the price of a barrel of oil dropped to $20 a barrel, which is really low, right? There are a lot of uncertainty in that, and they're probably not gonna drill new holes to subtract oil, but just probably freeze whatever they have going on. So what do you do if you live in one of those places? I think your options are really limited. You probably are going to buy guns, a lot of toilet paper and a lot of booze, and just try to survive and shelter in place, because there is nothing else you really could do. Like those, no matter how you look at it, I would be very scared for those markets, especially. And just to finish on those bad news, if we look at everything in general, at all of the articles that we read, it really comes down to three things. And we'll wrap up on this. So first of all, job losses, they're huge. No income stops economy. Our economy right now suffers a heart attack, which means the heart stopped, right? It doesn't work. And the Fed's coming in with their big bazooka and they say, we're gonna print a lot of money. It works the same way as they would, inject new blood in a system. But the problem is that the heart stopped. It doesn't move the blood through the body, right? So there is no velocity. The money doesn't go from one person to another, because someone who lost income, they hold the cash and it doesn't go to another person. So the money doesn't flow, and that's a really big problem, which moves towards the next problem, debt implosion. In our country specifically, a lot of companies are really leveraged. So big corporations too, it's all kind of gathered for the sunny day. If you have cash flow coming in and you have nice cars, nice buildings, nice everything, and you don't really see how it could all stop, you borrow more money. And we have a lot of corporations that borrow a lot of money, and now we have no cash flow coming in. So the question is, how will they survive? What the government will do to help them to pay their debts, because they are heavily leveraged. And in that being said, the third and the big problem, and I'm not a chief economist by any means, I know very little, but what I know is that people are thinking, will the dollar survives this whole thing? And this is a very big and deep question. But if we keep on printing money, obviously we'll have inflation. And with that being said, this 3 or 2 trillion package most likely won't be enough to print. So we'll have more money printed in the future, and that will create inflation, which is interesting to see how it will relate to real estate market, because technically the money that you will invest today, either in real estate or anything else, with inflation, you'll have cheaper money later on to pay off your debts that you will have. But anyway, I'll have Cody touch on that, but those are the 3 big ones, really big concerns on bad news that I've been learning a lot lately. So the question is there hope? We all want to see some hope, and I love to research memes and what this guy says. Now there is something I haven't had for a long time, but I do believe personally, and again, you will have your opinion. We so far have 11 people that say that we will survive. It really comes in our area. We have a lot of diversification when it comes to employment. Will we take a hit? Most likely we will, but I do personally believe that we will survive just because of amount of companies that we have in our particular region. Miami, I said about Las Vegas, I said about other places. Bellevue and Seattle have been really strong employers, and we have lots of companies. Costco's making sales. People spend a lot of time online. So Salesforce, Facebook, those companies, I haven't read too many, or if not any bad news from those guys. If I would be reading that Facebook is not coming to Bellevue anymore, I would let you guys know, but I haven't seen so. Same with Amazon. I just read that they are still on track to go to Bellevue. They have 4 towers in Bellevue. And just because our employment is so diverse, I think we have a greater chance to survive. Even if we will take some hits, which probably we will, I think that our real estate, and we'll talk about that in a second, because of our employment, should keep going strong. And really few quick slides. How important is technology to Seattle? It's huge. If you really look at this visually, which we know that Amazon is huge here, 13 million square feet of space. Google, 1.6, and Facebook, 800,000 square feet of space just in Seattle. And with what we have seen, in Seattle, we have affordability problem. And I really like this slide. When you look, all of those companies and cities in California, only, San Francisco, 7% of people can afford live in San Francisco. Think about that. Compared to California, Seattle is 46%. It's still absolutely horrible, right? It's not an affordable place to be at or be in, but comparatively to California, we still are fairly affordable, and that's why we have so much migration from Cali moving to here and bringing those jobs in. And I think we still have. I just talked to a few recruiters to Google. They still have their interviews, and they're working. So what does it mean for Bellevue? It means that we still have lots of action going on. Everyone knew that Amazon is coming to Bellevue, but as soon as they announced that they will bring 15,000 people, market exploded on the east side, and they by now will have 4 towers. They have Expedia building. They're building next door a brand new tower, and they have 2 more towers in downtown Bellevue that are in the works right now. Besides those, I really simplified Facebook. I just read that there was another deal done for apartments right next door. There was 1 acre in, if you are familiar with Bellevue, on the Bellevue Redmond Road corridor. They have 22 acres of land that will be completely redeveloped in years to come. There was 1 acre sold for $12 million to bring a lot new apartments, because Facebook is moving to Sprint District. They're building right now 4 new buildings to create additional 1 million square foot of space in Sprint District. They haven't canceled the deal. Google, same thing. Kirkland Urban, downtown Kirkland, they have a tower. They have a tower that they just purchased. They built another one, and they have more in Seattle. And same, Apple is still planning to move to Seattle. So with that being said, I do believe that we have hope in our residential market on the east side, just because of this diversification. So the question is where the market is for the months of March. Let me run you through those numbers, and I'll explain what they mean. So 2020 to 2019, this is east side. I'm in Bellevue. If you're curious about Seattle or any other city, I'll drop those numbers for you. But to simplify things up, 9% improvement, appreciation year to year as of months of March, which means that the market still been pretty hot. Those ones are fairly interesting. So if you look at the months of March, 50% of listings on the east side of all areas, 50% had sold with multiple offers, which is about list price. 17% had sold at current price. Only 16 sold below, and another 17 price had changed, which most likely they lowered the price, which is absolutely huge. The median difference from the list price for those that sold about asking price was 6%. So we still have seen, even with the coronavirus and everything that's going on, we still have seen pretty strong sellers market. I'm not being naive, right? I just explained all of the problems that we have, all of the challenges in the economy, but with the same being said, here locally on the east side, 50% of listings for the months of March still went higher than what they've been listed for. And the average days in market, 2 weeks for the ones that sold at price, and 5 days for the ones that sold over. What I'm trying to say about this means is that if the property is well presented, if it's a great either deal, or it has great value, or it's close to the core, or it's just good, let's just say if it's a good property, it will sell in today's market, period. It's just the way it is. Will it adjust months coming forward? We'll see. But as of right now, it's been pretty strong. Let's see next what I've got. And of course, the reason for it is the months of supply, the months of inventory. All comes down to supply demand. I hate being bothering on this one, but the supply is really low. It's just the way it is. So 0 to 2 months, even to 2 to 3 months. What is supply of inventory? Supply of inventory means that if there would be absolutely no new listings coming on the market, it will take 1 month for everything to sell off. Okay, so 1 month is really quick. I just have a friend who moved from Las Vegas and here, and absolutely he's blown away by, he sold his home there for 400,000 and a similar home here probably worth 1.5 million. So he's like, oh my God, this is insane of what's going on here in Bellevue. And I asked him, so how much time did it take you to sell your home in Vegas? 8 months. So 8 months compared to 1 month in Bellevue, and that's why you see the difference of, why the prices are where they are. So with that being said, in here, quick disclaimer, when we talk about sales in March, it means that those contracts been put together in February, right? Because they have to be put together in February and they close in March. With that being said is, for the half of March, at least, we know that the market, we don't have a clear picture for 100% of where the market is today, because it's always is changing. But I know for a fact we have office meetings every Tuesday, and we all share what do we see on the market, who has what listings and what. All of the good listings that we had, and me personally included, we had multiple offers. So we will see, it will depend on where the inventory will go. And here's what I personally don't know to tell you. If it goes up and we see more inventory, people put in more homes in the market, we'll see more balanced market and the prices will probably get flat around here. And if we see inventory going down, which I personally think it probably will, because sellers too, they don't really want to move during these times, right? We have shelter in place orders. So this is, we're in the middle of pandemic. So I believe that sales activity and inventory probably will go down. We, those listings that are coming on the market, there are still buyers out there ready to buy. Either you think that they're crazy or not, but they are there and they just want to buy a home. And the reality is interest rates are really, really low. Cody will talk about that. Historically, they are freaking low and it's a good time to lock them down. So I'm about to finish. I hope I didn't go too fast, but you'll be able to see this in the replay. So 2 responses that I see from people right now, and I talk to lots of sellers and home buyers, and one is, I'll sit and wait, right? Which is very typical, and folks are responding with fear, and they literally get frozen. I talked to this investment folks that they own a lot of real estate. And I asked them, so this is the deal, are you guys buying it? And they're saying, well, we're not buying right now. So 2 days later, I called them. I thought, well, maybe they want to liquidate something. And I called them, so were you guys ready to sell? Let's sell some of your properties. Let me do this work for you. And they're not selling either. So they're not ready to buy and they're not ready to sell. They just want to sit and wait to see what happens. And that's normal. But the approach that I personally take, and I recommend you to take, think and act, okay? So I respond to what's going on with curiosity and action. And we'll talk right now to what you can do. But I think, sit and wait. You can sit through the whole thing and nothing gonna change. But if you really think of what's going on and take action, I personally believe you will be in a better position. So what action can you take? Become educated, learn. I believe that right now is the time to get on the call, to figure it out. What do you want? What are the things available? I work with lots of wholesalers. I've seen some properties pop up in Bellevue and East Side that are not listed, that could be purchased at some discount. I think right now is the time to be asking questions and figuring things out. Get cash. Cody will talk about, what are the ways you can get funds. But the thing is, history says when you need cash the most, it's least likely to be there for you in spite of the marketing slogans. What does it mean? There is no thing is, if this whole thing will crash and real estate will be half price of in the best neighborhoods of Bellevue, there would not be a thing where you go to the bank and you say, oh, I like that house. Could I please have 0% down payment loan ready to buy? Financing will change too. So you got to figure out where you will take funds to potentially act when the opportunity will arise. And that's the thing that you need to figure out now, if it will happen. Changes to financing, we'll already seen, Cody will talk about this one. On our investors, there are hard money lenders that are not there anymore. So there are already ways harder to get financing today for either it's fix and flip or something that is non-financeable. I've seen on big commercial loans, big apartments, 50 units, 100 units, they're asking for lots of reserves. So if you're buying 100 units right now, they will ask you additionally to have, I'm throwing an educated number out there, 700,000 to have in reserve. So you're supposed to have your down payment, everything, and then rules are changing as we go. So you want to figure out what those things are. What are the changes to financing, and what can you do? And same comes to credit lines. Cody will talk about that. During 2008, they got frozen. So if you're thinking, well, I'll just wait for real estate to go down and I don't know, do HELOC, whatever, it might not be there anymore. And I'm not trying, Cody, to go into your lens. You'll talk about that. But it's just something that you can do now. Get educated, learn, figure out numbers, get cash, get liquidity, figure out how you're going to do it, what your plan is. Maybe there are some properties you do want to liquidate. Maybe there was a rental that wasn't so good anymore. Maybe we're not going to have that much appreciation from coming forward. Maybe it will be flat. Maybe it is a good time to liquidate that property. Those are the things that you should do now instead of sitting and waiting. Let's see, I think I have maybe one more slide left. What are the opportunities I would look for? Personal residence. If you know someone or you were thinking about maybe potentially buying a home, I honestly don't think it's the worst time to do that. If you look at it from the long-term standpoint, you will have absolutely low interest rate that you could get locked down right now. And if there will be some opportunities, maybe you will find something off market or on the market and there are no multiple offers and we can lock it down and you like the place. I always say you don't have to jump all the way and max out your mortgage payment. Maybe if you can pay a little bit more than whatever your rent is, I think it makes sense. I truly, honestly do believe it makes sense to do. Maybe we can look at investment properties. Maybe you have a few single family that you can liquidate. Maybe we will find some multifamily deals. I'll be honest, I thought there will be more on the market right now. There are still none. I've seen a few deals and they were okay and they still went penny within 2 days. So I think maybe we will see more down the line. But you know, it's something that we could look for, and that's why we should get on the call now to figure out if you're new to multifamily, what it looks, what we should look for, and how it works, and what opportunities out there. And if you believe for two people that say it all will crash, sell it all. We still can help you with that, but either you believe that it will tank or not. Maybe there are some properties I would consider letting go. I even thought about my primary residency, but my wife really likes the place where we live. But at the same time, I do believe that, you know, we're right next to downtown Bellevue, that we'll survive it just fine. But those are the decisions. I would say, let's get on the call. Let's figure out what you've got. And let's figure out maybe something needs to be liquidated so you will redistribute that money better. So with that being said, I believe we will survive. I honestly believe like 11 people that also voted on the same pool. At the same time, I believe we will survive here. I'm not naive and we're not blind. It's a huge blow to US economy. Absolutely. If we be anywhere else besides, you know, Seattle, I would not be that optimistic. But here personally, look, like in the core, tech workers, what problems do they really have? they still work remotely. Their biggest challenge is that their kids are home, and that's annoying. I agree, right? No, no, you would rather have them in the childcare, but you have to play with them. And right, people lost a few dollars in the stock market. I get it. But besides that, employment is still there. And I do believe we will survive. So that's what I've got. Cody, let's do Q&A. If anybody wants to chip in and ask me some questions, I'd be just unmute yourself and ask them. Oh gosh. Yeah, and we'll just go back to financing. I hope I didn't go too fast. So up to you guys. Ask questions if you have them. If not, we'll go to Cody.
Hi, Igor. Hi, everyone. This is Yelena. First of all, thank you so much for the presentation. That's very interesting. Definitely interesting information. So I was just wondering, kind of get your opinion. We already went through the market downfall in 2008, correct? Where the real estate property dropped, economy dropped. So how that might be different this time, since we already see a lot of unemployment that will affect the economy countrywide and globally as well. So how do you think that might be different for real estate this time?
Yeah, this is a great question. And Cody, you can answer this one too. So in 2008, what we had is we had a lot of bad loans, right? So you could make $10 an hour. You could go to your mortgage lender and say, I make 100,000. No one would check. They would give you $1 million, and you would go buy whatever you want, and they will give you some cash at closing to make you even happier, right? So when shit hit the fence, people didn't have, they couldn't qualify for those mortgages. They couldn't make those payments, right? And the domino effect, it all fell down. In today's market is different. It's a different kind of recession. Those people, they qualify big time. It's really challenging to get a mortgage. There are a lot of, documentation you need to bring and prove and say that you qualify for it. But the thing that happened, the hard stopped, the businesses closed, and this potential recession, what do we have in here? I think it will be stimulated by loan payments that cannot be paid of all of those big corporations that took a lot of money, right? On. So where I'm going with this, consequences could be the same, but the reason for it is different. We've got a pandemic. Not a loan mortgage fraud that we've seen in 2008. So, I believe that here locally, people, all of us on the call, we still paid our rent and our mortgage didn't change. So that looks different. And at the same time, Feds and the president, the election is coming up. So they got to save the day. They got to print the money. And we see them being way more proactive than they've been before. They coming up and they, all right, we're going to pump cash. We'll give you money. We'll help businesses with payment protection plan. Just keep your employees on. We'll do some kind of forbearance. You can delay. We'll not allow you to foreclose on these properties, right? The foreclosures and evictions are banned. So it feels different than it was before. They were not as proactive before, but those circumstances could be different because no one's seen COVID-19 before. If that makes any sense. Cody, you can add more to this.
Yeah, I would say that you hit the nail on the head. The credit quality is totally different this go round, right? Back then, you could have a sub 600 credit score, zero down, negative amortization loan. Like the quality of borrower is so much better now. Also, I saw a stat the other day that 56% of homes in America have 50% or more equity as well. And so the reason why we saw massive amount of foreclosures and short sales was because people didn't have any equity in their homes. They didn't put any skin in the game, and they also didn't have enough time from the peak of the market to the bottom of the market for things to go up before they went down. And so if we had a 10 or 15% reduction in value, most people would still have a serious amount of equity in their home. So if they were going to sell, they would be able to sell and still get equity. But they're not probably going to be forced to sell, and they're not going to have that, I don't think anyways, they're not going to have that sense of woe or dread thinking, I paid $400,000 for my house and now it's worth $250,000. and I'll never make that money back. I was in the business from 2000 until now, and I can't tell you how many times I heard somebody tell me, say, it's never going to come back, right? The folks on the call that say it's going to crash, right? It might crash, but it will probably come back, right? It always seems to come back. So if that does happen, and people don't have that sense of woe that they'll never come back, and now partially also because we've just seen it, right? In our lifetime, we saw a 30 to 40% reduction in home values, and then a rise of home values to go back and go above the peak levels from 2008. So I think that we've got a lot more experience behind us, and we'll be able to weather this storm better.
Right. Thank you, Cody.
Yeah, you're welcome.
Anyone else, guys, before we go to Cody? Feel free. This is the time. All right. So with that being said, if you'll think of something, just write your question up or text us to the chat. So I guess I have to stop sharing. Okay. So Cody, you try to share, and I hope it works.
Yeah, you bet. And I just have a few slides to show, not really a presentation, just a couple of things I wanted to share with you guys.
Yeah.
Let me grab the screen share here. There's a lot of choices here.
All right, we can see your screen.
All right, you see this. So this is an article, and I can send this to you so we can all share this as well. Do you see that mortgage crisis, Fed unintended consequences?
Yes, seeing great.
Okay, sweet. So this is a great article that I'm going to paraphrase and really dumb down a little bit for speed's sake, and the fact that this is written a lot more towards mortgage professionals than it is the general public. But generally speaking, what happened was that week, about 3.5 weeks ago, where the stock market started going down, right? The Friday before that week where the stock market really started going down, we were actually living high on the hog. Mortgage rates were really, really great. COVID-19 hadn't really taken its hold on the country or even the state. We'd started to have a couple of deaths in Kirkland, and people were getting a little freaked out, but things were still okay. Mortgage, because of that, a little bit of negative news in the market usually means interest rates for mortgages get better. People have a little, what they call flight to quality, where they go away from a stock and they go into the MBS market or the mortgage-backed securities market. So we saw that. We saw that in the week before. And then we saw on Monday when stuff hit the fan, right? So the stock market lost 2,000 points on Monday, and then another 1,000 points, and then another 2,000 points. It just went down, 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 down very quickly in a week. That normally, for small moves in the market, would again be good for mortgage rates. What happened though was money was sucking out of all the markets, treasuries, mortgage-backed securities, and stocks. And so that led to higher and higher interest rates. And so rates started going higher. People were freaking out about the stock market. So then on that Sunday night, the Fed had an emergency meeting and decided they were going to cut the Fed funds rate by 1% and start buying mortgage-backed securities. And so the news was that the Fed moved interest rates to zero. So we got a ton of calls for that 0% mortgage, right? That's not how it works. The Fed changes the Fed funds rate, which in turn changes the prime rate, which impacts things like your credit cards and your car loans and your home equity lines of credit. So those interest rates did get better right away. Mortgages are different though, and you're talking about borrowing for 15 or 30 years as opposed to quickly. And so what we saw though was the Fed started buying mortgage-backed securities, which was really, really good. And so actually I'm going to grab a different slide here. This is a very rudimentary slide, but you can see, I gotta probably drag this over. All right, you able to see that slide now?
Yeah.
Okay, so the starting from the left, that's that week and 2 weeks where things are getting better, everything's great, mortgages are awesome, and then that big red week where you see things just go down, down, down. That with the C above it, that's where COVID came into our marketplace, right? It really was taking a hold. Then you see the FM, the red FM there. That was the Fed move. And so what this graph is the mortgage-backed securities market. And as the price goes up, the interest rates go down. So we like to see those green days. Those are really helpful days. So you see a lot of red negative days under the C, and then you'll see it gap up, which when the Fed said they were making a commitment to buy mortgage-backed securities, the market reacted very favorably to that and really spiked up. But then what happened is that mortgage companies lost some value in their servicing portfolios, because what also they did was they introduced the idea of forbearance and not having to make your mortgage payment. So what that does for a mortgage servicer is it devalues the value of their servicing portfolio. Imagine if you were a mortgage servicer and you had $5 billion worth of mortgages and you're expecting to get some revenue on those mortgages, and now there's a possibility that some percentage of them will not pay, right? And will not pay, not because they can't pay. Sometimes they couldn't pay because they lost a job or what have you, but now the federal government has come out and said, hey, sign up for this and we'll grant it for you, right? You're going to get 3 months with no mortgage payments. So that really hurt the value of the servicing portfolio. And then we saw the rates kind of do this where they were jumping up and down. So this next week, after that week underneath the FM, we saw really spike up, right? You can see it. What happened was the Fed started buying mortgage-backed securities to a really high level. They spent $168 billion in mortgage-backed securities market that week. And that pushed interest rates really, really low. But what we saw was, we saw mortgage companies were chock full of volume, and they just saw their servicing portfolios cut in half. The value of a servicing is, generally speaking, if we go back to that other slide, let me get back that pulled up here in 1 second.
It's about 3.3%, right? 30 basis
So the
points?
servicing for a mortgage company is about 1% of the value, right? So if you've got a 100 billion dollar servicing portfolio, then that's going to be worth 1% on your balance sheet. So about $1 billion, right? So it's a lot of money. And then what happens is, as a servicer, the reason why you would do that is you're going to get the value for that. And every year you're going to make about 0.3%. That's right, Igor. So your income from that servicing portfolio is about 3%. But companies will buy servicing, or they'll not sell the servicing and not get that 1%, or they'll buy it. And in order to buy servicing, you have to pay 1%. So you pay $1 billion to get a $100 billion servicing portfolio, and then make it back a little bit at a time, about 3 years. And so what happened was, when twofold, when they introduced the idea of forbearance, that meant people could not make their mortgage payment, and that mortgage companies still have to pay off the coupons. And now they've pushed interest rates a lot lower, so the chances are good that some percentage of that $100 billion servicing portfolio is not going to be there anymore. They're going to refinance. They're going to go somewhere else, or they're going to get a lower interest rate. And so if the value of that servicing portfolio is going down, then they may not be able to collect. They probably won't be able to collect that extra 0.3% per year. And so now that 1% they paid for it isn't worth 1% anymore. And so what happened was, overnight in that week, the value of servicing got cut from 1% to 0.5%. And so as a lender, if you've got a $100 billion servicing portfolio and you thought it was worth $1 billion, now it's worth $500 million. And where that's really important is lenders use their balance sheet as their ability to continue to lend out more money. And so if you have an asset that's worth $1 billion, you could lend maybe 10 times that, right? So you could maybe lend $10 billion every month off of that servicing portfolio. But now if that got cut in half, now instead of being able to lend $10 billion, now you can only lend $5 billion per month. And so what we saw was lenders started tightening up. They raised interest rates in the face of the bond market showing that there should be favorable interest rates, because they didn't have the ability to be able to lend any more money out. And so what that means to the consumer is, you're seeing the news report that rates are at all-time lows and that MBS market is going so great, but you're not actually seeing it on a rate sheet for a lender. So it put us in a tough spot, right? Everybody's expecting to see better and better interest rates, but they're not on the rate sheet. So the good news is, if we go back to that other slide, then what we can see is, we can see this leveling out. Here on the right-hand side of that graph, we see that kind of flatten out. We had one really big crazy day, and then some very, very small moves on the days. And what you can see too is volatility. Volatility is harmful to servicing and to the mortgage world as well. If you look back on the left-hand side of the graph, starting at the 222, those are normal size days moves, probably anywhere between 15 and 30 basis points per day. Then you see those big weeks where they're big red numbers and then big green numbers. Those are like 250 to 300 basis point moves. So what that means is, we saw 3 weeks solid of 8 to 10 times the normal moves in a day. And so that's really tough to price a rate sheet, right? We saw one day, I think the record that I saw was 9 different rate sheets during the day. So that means there's 9 different moments in time where our pricing desk says, things have changed, we have to change this. And it was up and it was down and it was up and it was down. And it was just a crazy wild ride. So the good news is that we have settled in. The Fed has kind of slowed down. They pumped the brakes on buying mortgage-backed securities because they came into the market like a hammer, right? And now they're being a little more tactical, right? And doing it the way that they need to be done. So I think, and we're kind of jumping ahead to the good news of my presentation is, I think interest rates are going to remain at these low levels for quite some time, right? And now Igor mentioned the election, right? We've all kind of stopped talking about the election. It's not even really in the news cycle anymore with everything else going on. But as of right now, anyways, it's still happening in November, right? We're 7 months-ish away from having either another 4 years of Donald Trump or a new president, which either way, those are going to be momentous events, right? It's going to be very, very important to what policy gets made after that. And we're really not talking about it anymore. So I've seen this market go absolutely crazy, more so than any of the other big crises that we've seen, from the housing crunch and the mortgage collapse, 9/11, like dot-com bubble. I've seen all those different things that have happened in my career, and nothing has moved as fast or as furious as this particular event. And the good news is that the Federal Reserve and the government is acting very fast as well. It took them a long time to jump in and help in 2007 and 8. And so now, I mean, it's only been a matter of a week that we saw the stock market and the mortgage market go crazy, and they jumped in and started helping. Now, what they did hurt before it helped, but now they're actually doing it right and helping out our market a bunch. So we covered why things got crazy. We covered why interest rates were not necessarily where we thought they would be. The good news is we're working through that slog. Our team and our company and our industry as a whole is working on about 3 to 4 times the normal volume that we would see at this time of year. And so what that means is turn times are extended. Mortgage companies are not in a rush to lower interest rates because they already have more volume than they can service, right? So you get into the reputational risk. Like, if I can't get back to a customer for 10 days, then they're probably not going to be my customer anymore, right? And so we're limiting things a little bit still because we're trying to work through that pile. But I think in the next week or two, we're going to see things really normalize. We're going to get through the initial slog and be in much better shape going forward. Gotcha.
Well, Cody, question to you is, assuming that rates are stabilizing, which is pretty good, there are some products, there are some those investors that pulled the money out of the mortgage business, right? We see some hard money lenders disappeared.
Yes.
I heard that some jumbo loans are not there. Could you just mention really quick, what is the jumbo loan and what is kind of changing about jumbos right now?
Yeah, sure. So the federal loan limit for Fannie Mae and Freddie Mac loans is about $510,000. In certain areas of the country, including ours, King, Snohomish, and Pierce County, they have an expanded limit for higher cost areas, and that goes up to $741,000 and $741,750 in our marketplace. So any loan that's above that 741 mark is considered jumbo. And that is really limited right now. A lot of investors have stepped out of the jumbo marketplace. And the reason why is, you mentioned supply and demand with houses. The same thing's true with mortgage, right? Right now, the federal government is buying mortgage-backed securities. So mortgage-backed securities what they're buying are Fannie Mae and Freddie Mac and Ginnie Mae loans. So that's a loan size in our neck of the woods under 741. They are not buying jumbo loans. Right? So if you've got a jumbo loan, the only source to be able to sell that is some other investor. And those investors have dried up. And so the only way that a bank or an institution is going to lend on a jumbo loan is if they're going to hold it on their books. Right? And so if you're going to find a jumbo loan, it's going to be with a bank that's going to continue to service that loan either forever, or they're going to hold on to it now, assuming that someday down the road, whether it's 3 months or 3 years, the jumbo market comes back. And we saw this happen last time too, right? In 2008, jumbo was gone. Non-QM was gone. The subprime lenders were exploding and going away as well. And it was simply because there was no market to be able to sell that mortgage after it was produced. So if you are willing to sit on it, then you could do that loan. But if you were not, and you're not willing to take the risk, then you wouldn't issue that mortgage anymore. And I actually had a buddy at my company that was locked on a refinance on a jumbo loan with a different company, and they canceled his lock. So in the middle of his refinance transaction, they said, we're not going to deliver this loan. So we've not done that. We've held to all of the locks. I've got a jumbo that's closing tomorrow, but we're not taking in a lot more of the new ones. And so what we've done instead is we're utilizing the loans that we have that are still being bought on the secondary market by doing like if somebody's going to buy $1 million house and they're going to want to put 20% down, that would be an $800,000 loan. But now what we're doing instead is we're doing a $741,000 first mortgage and a $60-ish thousand second mortgage to still get them the loan they wanted as far as loan amount, but we're separating it out into two mortgages. And I have another one of those going right now where his second mortgage is $350,000, right? Because he needed to borrow whatever that would be, almost $1.1 million. So there's ways around that. But what I think we're going to see is that the upper end price points are probably going to suffer a little bit because of this, because it is a little harder to find financing. We do have outlets where we can do jumbos, but they are going to be a little bit more expensive because the investors that are going to do those know what they have, right? They're still offering to do these, but they're not able to sell them on a secondary market. They know they're going to have to take a little bit more risk, and with more risk comes more reward, right? So they're going to charge a higher interest rate.
Makes sense. So, I mean, we're coming back to the same supply demand, just like you said. If originators of those loans know that there might be less demand, and there is less demand for them because now it's more risk to spend more money, right? In the middle of all of those, they don't want to originate it, and then it comes back and forth together. So the reason I pointed this out is that financing, just like real estate, it comes hand on hand together. All of those people that have been saying through the years, wow, I'll just wait for this whole thing to crash, which is great, right? It might. But the thing is, the financing will look different too. And that's the point that I want to, just to make that people understand it. Like your financing option will different that in the regular market, even if real estate values would go down, it will in fact a lot of other industries which will impact financing.
And one other thing to add there too, Igor, we're also seeing some credit tightening on the lower end of the buying pool as well. So FHA is one of the big
Cody, before you continue, you can maybe stop sharing and we'll just have a little bit conversation.
Sure, yeah, that's no problem.
Just in Zoom.
Yeah.
So you were saying in the lower financing, besides jumbo FHA, there are some changes too?
Yeah, so FHA is kind of the opposite of jumbo in the sense that it's meant for first-time home buyers, right? It's a low down payment, usually has lower credit score requirements. It's a little bit more forgiving in a lot of cases. They've just made some adjustments to that where Caliber Home Loans, the company that I work for, up until this change recently, we could go down as low as a 580 credit score with 3.5% down. So, I mean, that's a pretty aggressive product. There were no reserve requirements. You just needed to get a automated approval on that. Now that minimum credit score is 620.
Oh, wow.
So it's up 40 points from that. And if you're between a 620 and a 660, you have to show that you've got some extra compensating factors. So that might be like 6 months reserves, right? That could be no more than a 45% debt to income ratio. That could be a residual income calculation, which basically is if we take your net monthly income minus your mortgage payment and all your other debts, there's a certain percentage that if you have over that, that's a acceptable loan. If it's under that, it wouldn't be helpful, right? And so what that means is if you're spending almost all your money every month, then you're not going to be as qualified. So those sorts of things are new and just interjected into our world. So I had probably about 5 clients where I had to make calls and say, hey, there's been some changes and your credit profile doesn't fit into the mold anymore. So here's the things that we need to do to get you back to be a buyer, right? And so going forward, that's going to be an issue for first-time home buyers, which a first-time home buyer has an issue getting a home That means a second-time home buyer or a move-up buyer might have an issue selling their home, right? So those are interesting things to be thinking about our market and where things are going. I'm an investor, and so I have a number of rental properties. And so if you're an investor in the group, that's not necessarily a terrible thing, because a lot of your renters might fit into that category where they're 620 credit score, 660, 650 credit score. Now they're not going to be a buyer, so they might need to continue to be a renter for a while longer.
Well, that's, that's not the best thing for them. Of course, good for you, but
trying to find the silver linings for the rental market, right? Because we've got a lot of folks that are out there that are worried that people are going to lose their job or not be able to pay their rent, that, this will secure a few more folks to stay where they're at with regard to rental properties, which I think will also lead to value increases in rentals as well, because it will be a stable spot to have your money.
Okay. Well, Cody, I've got last question for you, and we'll open for Q&A. So as we see, real estate market is dynamic, is changing. We have inventory swings. We see financing markets are changing. Interest rates are changing. Some loan products going away. It got definitely a little harder to qualify for financing. So assume that it might not crash or it will crash. We'll see. We don't know, right? But assume that we will get more opportunity. Let's just put it this way. Maybe we'll have some dips in the market. Maybe real estate values will go down a little bit. I think it actually could happen. The question to you is, assuming that folks that are on this call, they're employed, they make decent salaries, they might own real estate. The question is, where do we take cash today? What are the options that you think to get liquidity that you might recommend? I know that I touched a little bit on HELOCs and things of that nature. What are your thoughts on that?
Yeah, I think if you've got property that has equity, I would be taking a cash out refinance on that. If you're going to know you're going to put that money to work in the next 3 to 6 months, based on what their anticipated idea of what's going on in the marketplace. If you just want to have liquidity and you're not sure that you're going to actually even put that money to work, home equity line of credit's a great option. I'm an investor, and I'm actively seeking buying more properties, and I want to be ready for if there is a dip in the marketplace, which I think there could be. It wouldn't stop me from buying a great deal right now, but I am looking for opportunities coming soon. So I'm actually personally doing 4 cash out refinances on rental properties right now to free up a nice war chest to be able to go out and buy some more real estate when the dip happens.
Gotcha. That's so cash refinance or home line HELOCs. The also option that I heard people been talking about, even if you have HELOC, there was a lot of talk that 2008 they got frozen. So you have it today, but they could cancel it tomorrow. So I know quite a few people that actually pulled the money out of the HELOC, and they're paying interest on that money right now without actually putting to work. And if they not end up using it, they will just close it and will pay a few dollars in interest. But if not, they know that they already have cash sitting in the bank. So
I did the same thing. I took out the draws on full line of credit that I had. And I'll tell you why, because in 2007, I did the same thing. Bought a house in late 2006, and I put a home equity line of credit after I bought it. And I saw the writing on the wall, and a couple of my clients had their lines frozen, and I went out and took all that money out. And then like within a month, they froze the line, but I'd already taken the funds and I had it in the bank. And that was my war chest to get started. I didn't own any rental properties at that point in time. And now I have 80 doors. And I would not have got that without having that money in the bank, right? I would not have been able to do it.
Gotcha. So for you guys that taking notes, we will open for Q&A in a second. I would just say market is shifting. Think and act. We believe the best approach is there will be opportunity. There will be some deals for sure. I recommend if you're looking for primary residency, get pre-approved. If you want to look and learn more about multifamily and where to get cash, get Cody on the call. Talk numbers are first. It's not about the property. It is actually about the money first, right? If you're not able, if I bring you an amazing deal in the East Bellevue tomorrow, if you're not able to act on it, it doesn't really matter, right? Like, yeah, you will look at it, great. But money and numbers come first. And we should talk to what is multifamily? Do you want to find, a place for yourself? Do you want to find investment property? What that will look like. So I have it on my list because I look at deals all the time from wholesalers, from other investors. We do a lot of cold calls. We make lots of calls right now for our builders. I have all kind of clients, but when I know what they're looking for, it's easier to find rather than just, send me deals. So get ready, get educated, contact us. We'll be more than happy to help. I think this is it, just to keep it simple. I would say if you guys have any questions, just ask. This is the time to do it.
Okay, so question for Cody. What are your thoughts on a recession and how does that affect the mortgage rates?
Yeah, you bet. Over the last 5 recessions, that's always meant lower interest rates. So I can't say what's going to happen because it happened in the past, but every time we do see a recession, we see lower and lower interest rates. And it just so happens that based on the last, the last 5 recessions, every time we had a recession, the rates got lower than the lows of the previous time. So, and we're already kind of seeing that, right? So I feel like we're probably going to see rates be in the low 3s to high 2s for 30-year fixed rate owner occupied finance.
So then are you suggesting that we should change our strategy based on that?
I guess it depends on what your strategy is right now. What do you mean change your strategy?
Like, should we wait to buy when those rates are dropping, or?
That's a great question. And no, because the way I see it is I look for deals on properties and I don't wait. I don't wait for rates. I don't wait for markets to crash. I wait for a great deal on a property and then I execute, and then you can always refinance, right? Refinancing is relatively cheap and easy. And that said, rates are great right now, right? Don't get me wrong. Rates are amazing right now. They're some of the lowest we've ever seen. I just think they possibly could go lower. But what you don't want to do is pass up a deal that you could maybe make $100,000 in equity in, waiting for the rates to go down by 0.25%, right? I would say if you get a great deal, buy it now. Try not to pay any points. That's going to be the important thing, right? Is we're trying to set up most all of our deals right now with no points or maybe even a little credit. Because if you don't pay a bunch of money for that mortgage, then you didn't invest a lot in getting it, right? Generally speaking, you're probably going to pay $3,000 to maybe $3,500 for a transaction. And so if you don't pay points and you just pay the transactional costs, and then you need to pay the transactional costs again in 6 months because rates have come down so much. If it costs you $3,000 to refinance and you save $200 a month, it breaks even in 15 months. So if you plan on holding that property long term, it's well worthwhile.
I would totally agree. As you said, rates are fantastically low right now. I mean, like, how much lower do you expect them to go? Like, it can be 1%. I mean, then
no, I mean probably not. But I could honestly see them being between 1/2 and 3/4 lower than they are right now. But here's the thing: that's like trying to time the stock market, right? Like if you had the foresight to sell on that Monday or the Friday before the market crashed, and then you bought again when it hit around 20,000 for the Dow, well, you'd be the smartest guy around, right? Because you sold at 30 and you bought again at 20, and now it's at 23 or 24, right? Like if you could time it perfectly, by all means, go for it. But instead, what we usually say is with timing stock market is don't try to time the market. Buy on a routine basis. And if you do that with real estate, if you just dollar cost average, you're going to do great. And then when there's an opportunity, like right now for myself, I've been buying real estate since 2007. Now I have a great opportunity to be able to refinance 4 of those properties to all-time lows and put cash in my pocket, right? And it's costing me, again, I'm a relatively open book. I want to say it's costing me around $14,000 to do these 4 refinances, and I'm freeing up $400,000. But that $400,000 is going to make me 20% on that money because that's the kind of investment that I buy. I buy things that I can do value add, and I do things where I can come back in and raise the rents, and I basically burn, right? So I'm going to use the buy, renovate, rent, refinance structure. And so now I've got a nice new war chest to go out and buy these properties and turn around and make even more money. So if I can't make back that $12,000 that it cost me to get access to those monies, then I don't have any business borrowing that money, right? So I would say if you're an active investor and you're a burst style investor, or even just a buy and hold long-term investor, you'll be able to make the cost back on those refinances pretty quick.
And we could do another webinar on this, where what are, different investment strategies they are. They're also changing right now because, value add, and Cody, as you know, value add right now could be a little risky because we don't know exactly what the future value would be, right? You can't 100% predict it is right now, but it's definitely still works. But the point is, it's not about 0.25% change of interest rate. I mean, if we find the deal, if it's a really nice place in Bellevue, for example, and we know it's a deal, just like, deal is a deal. We'll figure out the 0.25% rate later if it will change. Yeah. Any more questions, guys? There we go. Phil's quiet.
I do have one more thing I wanted to share, Igor, if I can pop in there and screen share this for you.
Yeah, please do.
And this is, I just actually pinged Matthew Gardner, who's the chief economist for Windermere, and he shared this slide with me. Let's see if I can get it. You guys see that?
Yep.
Okay. So what this is, it's not really tuned up, but what this is the blue line is the Case-Shiller index for home prices in Seattle, right? So you can see there's a peak in 2000 and, what is that? Let's see it. Oh, there we go. Scroll down a little bit. That peak 2008, right? 2007, 2008. 2007 is kind of the peak of that blue graph. And then it goes down. We have our correction, right? And then we, on the steady trudge back up, a couple of little bit, ups and downs along the way. But what you see is from the start of this in 1990 to now, we're on this gray line. And what you see, that gray line is a 5% rate of appreciation. Okay. So the orange line underneath it is 4%. The yellowish line above it is 6%.
Okay.
So if you look at that and you see, we have been up and down, but in the long run, you get about a 5% rate of return on real estate. Okay. So does it make sense to wait it out and try to get a better deal? Yeah, maybe if you're a really good market timer and you think you can pick it. But if you look at real estate as a 30-year investment, you can pretty much bank on a 5% rate of return.
100%. And two phrases that I recently learned, like, you don't want to caught a fallen knife, which what people like, they want to see what happens. I
Right.
totally get it. The thing is, the uncertainty itself, that's kind of the indicator that makes people freeze. But at the same time, 10 years from today, we all will be happier owning real estate than not owning real estate. That's most likely a true statement. So I'd say we still look for deals, as we always do, and the buyers or sellers that are learning of where a market is and are able and ready to act, they could be in great position to move forward.
Yeah, one more addition to this. This is a little bit more dated slide, but this is the same graph with just the 5% appreciation, and the gray bars that go up and down are the last recessions we've had. And so if you look at the home prices, if you go back to 1975, you see the little blue index line, and now this is national. The blue index line during that recession pre-1975, it actually is fairly flat, maybe even up a little bit. You guys see that?
Yeah.
Okay. The next one's a smaller recession just before 1980. Home prices went up during that window of time as well. The one around 1980, relatively flat. You can't see it 100% because the red line goes through there, but relatively flat. The next one in 1990, relatively flat, maybe down a little bit. The recession in 2000, home prices actually were on the rise. And that was due to, in part, what happened in 2007, bad credit quality, right? We saw people that were buying houses that were creating demand that maybe shouldn't have been in the housing market. But inside that recession, home prices went up. Then the big one that we all remember, right? This is 2007, 8, 9. We saw a pretty significant reduction in home prices. But this recession, you'll see, happened after the home prices started declining. So what this tells us is housing prices caused the recession rather than the reaction of housing prices during a recession. Okay, and so this if we do enter into a recession, it's going to be COVID related, right? It's going to be business related. It's not going to be because of housing and because of terrible mortgage credit quality. So I do feel like even if we come into a recession, home prices will do fairly well based on the previous history.
100%. And that goes back to the slide that we talked before, right? Where are we located? If we were be in Miami right now or Las Vegas, I would worry. Like, and I still worry for our local economy, hands down, right? It's not immortal. It will shake, you know, things will be shaken. But at the same time, it is pretty strong in here. And I think we will do another one of those webinars in the months because we'll have a better data based on the full months of March of what was going on and activity in April. To know what happens, because I can tell you with the whole confidence, right now it's still hot, right now it's still busy. I don't want to predict how it will be. We talked about that during this call. We'll know in the months even better. So if there are any questions, ask them now. If not, we'll pause the recording. I'll thank everyone who joined, and I hope you liked it. I hope you learned a few things. I'll send you a copy of this recording so you'll be able to go through some things if I went too fast or Cody went too fast and review it again. So going forward, thank you so much. And if you have any questions, just ask them now. That seems like a wrap. Thank you, everybody. I appreciate it. And thank you, Cody. And
thanks, guys.
Everyone who listened. Thank you, guys.
Thanks.